Do you know what is the major fundamental change was happened in IEX? How much the change going to impacts the earnings power of IEX in next 10 years? Let's find out in this qualitative analysis. Welcome you guys to this channel Business Charts. This is a fundamental analysis series. This analysis is all about Indian Energy Exchange. As this is a qualitative side of analysis, we will check business analysis, industry analysis, mode of the business, key executive people and future focus of the business. First thing I will check Sharia status of the company, which is passed in all complaints areas. A brief information about the company: it is operated in power exchange industry and around 14,000 crore worth business today and functioning from 2007. Presently 152 employees are working in the company. Let's start from business analysis. The company has two business segments. One is energy exchange, which provides trading platform for physical delivery of electricity. Another one is gas exchange, which provides trading platform for physical delivery of gas. How the segments are working? If we see the energy exchange, generating companies, distribution companies and industries and commercial users are there. Distribution companies are mostly state-owned utility companies. They distribute power to individual houses and some industries operated in their state. So distribution companies and industries has to purchase power from generating companies, and they do it depends on their time frame requirement. They can buy for long term, which up to 25 years, and short term up to 1 year. Long term contract usually through power purchase agreement. On the overall, around 86% of contract is long term only, 14% is short term. On the short term side, bilateral contract, which is agreement between two parties to supply this much unit at this much price up to this much time, like that. Exchanges, yes, the IEX is operating here. Here trading time limit is up to 90 days only. And one more method, deviation settlement mechanism. Our concern is exchange in the short term section only. Total we have 3 exchanges till now: IEX, PXIL and HPX. HPX is just commenced the operation 3 months back. All the exchanges has only 7.4% in the overall trading volume. On the revenue breakup, 98% contributed from energy exchange. Last 3 years only the gas exchange is functioning, and it's growing faster day by day. And revenues generated mostly by transaction fees and subscription fees. Transaction fees contributed around 94% in 2021 from 89.2% in 2018. So more volume transaction through the exchanges, they got huge transaction fees, and annual subscription fees contributed around 5.6% in 2021. Other revenue resources are contributing negligible amount. So on the product side, they have products to trade electricity from next to 1 hour to 90 days. So customer can trade depends on their time requirements. Day ahead market, it is 15 minutes block basis, but the delivery will be the next day. Term ahead market is up to 90 days. Earlier it was only 11 days. IEX recently launched the long duration contract after getting approval from CERC. It is offering up to 90 days now, and later it will gradually increase up to 1 year. So management expects this will bring market share from bilateral contract to exchange. Real time market, it is offered for same day delivery after 1 hour. Green term ahead market, it is power from renewable energy generated sources like solar, wind, hydro, etc. Cross-border trade, this they have launched in 2021. The South Asia regions, Nepal, Bangladesh, Bhutan are the major participants to purchase electricity from India through this facility. And the renewable energy certificates, industries has to produce renewable energy in some percentage, so they have specific targets. If at all they cannot produce, somebody else done much higher than their requirement, so they can purchase from them to meet their targets. Energy saving certificates. Industries has to save some energy and they have targets. If they cannot meet a specific target, then they can purchase certificates from others who save more than their targets. All these products are used by DISCOMs and various industries. From this snap from management presentation, the strength of the business we can understand, they have 95% market share in energy segment. So this clearly says it is a monopoly business. They have huge customer base. So every generating companies and DISCOMs are registered with IEX. And the gas exchange side, they have major gas players in their platform and they are increasing their customers. And one major strength is company continuously adding new products by understanding customer requirements and moving towards digital future trends. If I look into the weakness side, in my view, I see the regulators are the big weakness. CERC and PNGRB. Yes, the company is highly regulated because there is no pricing power. Need approval for every change. So many factors might affect the company from regulation point of view. It's all they have mentioned in the annual report. The regulators have the authority to change the pricing structure of the business. We have to mind the regulators are not stakeholders friendly. They are just government entities. They don't care about the profitability of the business. So just look into public service. And the next weakness, CERC introduced market coupling. It is basically the buyers or sellers from other platform can be able to buy or sell from IEX platform. I can see this is a big fundamental change in the business operation. We will analyze this in the mode section of this analysis. Okay, why CERC wants the market coupling? First, they don't like only one company having major market share. And also the other thing, to optimize the operation of the generating plant in the country. So they believe this will reduce operating costs to distribution companies as well as end users. They have only one subsidiary presently holding 49% share, but as per regulation they must reduce to 25% in next few years. So even though gas exchange is growing at higher rate, the company will get benefit up to 25% only. Okay, overall the business looks simple and futuristic digital products that market needs, but one fundamental weakness is there. Next, industry analysis. The companies hugely depend on the power and gas sector. So understanding the supply and demand side of the industry is important. The supply side, we are power sufficient country. We have installed capacity of 404 gigawatt, but out of it renewables are 40% and our peak demand is 52% only. So supply side looks good. And the consumption side, of course, no need to explain the demand. The energy is now essential thing in our daily life. And we are the third largest consumer in the world. Further demand factors are coming from industrial growth in India and urbanization activities and increasing consumer demand. So demand side also looks very good for the energy sector. On the gas sector side, the consumption last year it is 164 million metric square cubic meter per day. Among the demand, only half has domestic supply and half we are import from global countries. So gas supply, we are depending on the global market. Due to the sentiment change in there, we will see price fluctuation. So gas sector side, demand for clean fuel is good, but India has not enough supply. The major gas consumed sectors are fertilizers, power sector, city gas distribution companies, refineries, petrochemical industries and few others. And if you look at the past and future expected growth things, the per capita consumption, that is individual person electricity consumption, increased to 50% in last 10 years from 2011 to 2020. And it is expected to grow another 40% in next 4 years. So past and future growth is really good on the energy sector side. As we are importing 50% of gas requirements, we have exclusive ports available to facilitate the transport. That is LNG terminal. The LNG terminal processing capacity is expected to grow 69% from the current level of 42.5 million metric ton per annum to around 72 million metric ton per annum, even though we are utilizing 55% of the current capacity. As the gas in the country transport through pipeline in most cases, and also we have other compressed methods are there. The pipeline network is expected to grow from 20,000 km to 35,000 km in next 2 to 3 years. So growth looks good. And the government support to this industry, India committed in the Paris Climate Agreement to reduce the carbon emission. So this will promote renewable energy, thereby reducing the emissions and promoting the natural gas in the overall energy basket, the clean fuel to increase from 6% to 15% by 2030. This move from the government will increase gas consumption up to 3 to 4 times from the current level. So now we have 164 and it will go up to 600. And the government proposed favorable budgets to promote competition, consumer choice and advanced technology in the energy sector, and a favorable policy to increase spot market share to 25% by 2023. So overall the industry looks good in the past and future expected growth. Also supply and demand side also good, and government support is also good. So everything looks good. Moat. Yeah, it is the important and core of any business to generate above average return, and this analysis is to find the depth of the moat and durability of that. I believe the economic moat of IEX is network effect, because it started with some small group of customers and the operation is within the company. I mean the buying and selling only within those customers of IEX. The small group expands to huge customer base, because the company is very transparent and competitive price compared to other short-term markets, efficient price discovery and more customer focused in terms of providing training of their products. So the developing the customers to stay within the company. Another one advantage is early mover into the market. So it is a beginning portion of the growth. If we check the pricing power of the company, they are collecting 4 paisa per unit in buying and selling. However, they cannot change it. Regulators have the rights to increase or decrease, so no pricing power. Even though no pricing power is an issue during high inflation times especially, it generates high profit margin even with a small fee. So important thing is volume of the transaction, because expenses remain at minimum level only. When higher volume transaction, then higher profit margin. So pricing power is not a big issue. Important is volume of transaction. Whether the moat is shrinking or expanding, the present operation is buyer or seller in the same company can only trade within them, and price discovery, order matching is done at exchange level, and peer group also doing that within their customers. But we know CERC wants to change this by market coupling. So when the market coupling coming to effect, buyers or sellers can be from any exchanges. So order matching and price discovery will be handled by market operator. So exchanges are just like brokers. The main competitive advantage of the company is something questionable in future. So I believe it will not remain same. Due to the change, the market share and profit may decline. So this market coupling brings a weakness into the company operation. And one more changes there, that is market based economic dispatch. Actually it is a big opportunity for all exchanges. Embed means all the electricity volume will have to be traded through exchange only. So just imagine only now 7.5% of the total volume is traded through exchanges. If all volume comes to exchanges, then it is a huge opportunity. Management believes around 10 to 15 times the revenue will jump. Okay, why regulator wants this embed? The regulator wants one nation, one grid, one frequency, one price. So they are trying to bring They call it as new regime. This will bring significant savings due to the cheapest generating resources to meet the demand. So they believe it is a win-win for both distribution companies and generating companies. But it is not simple to implement such scheme in one go. Phase-wise, the volume will move to the exchanges. What will be the position of the company in next 10 years? That we are trying to predict here. Even though all distribution companies and generating companies are customers of IEX, earnings power in the next 10 years depends on the market coupling and embed, because industry likely to change due to regulatory action. So my understanding in earnings power, there is not only one scenario to evaluate, few cases we have to check. The first one, what if exchange operations remain same in next 10 years? In this case, definitely there is no doubt company will do very well due to its deep network effect, even though the competition increases. So this case is clear, very clear. Company will grow faster than other peers. Second, if market coupling is introduced without embed, then network effect will not work as previous. But already all distribution companies and generating companies are using IEX platform. They are very well trained to use the products, and they will not immediately move to other platform. Yeah, few may have some backup account in competitor platform, as how we are having multiple trading account with different brokers. So it's all depending on the pricing structure of the competitor. So my thought, IEX may have higher market share and will be the leader in the power exchange industry, but current market share and profit margin will definitely decrease due to competition. The third case, what if market coupling introduced with embed? When both are implemented, even the decline in market share will be compensated by huge volume transaction, and profitability will not be a problem. So in all the cases, worst cases, at least the company will be the market leader with a decent market share around 50 to 70%. It is in my opinion. Yes, it is my own assumption, no guarantee here. The next section, key executives. Mr. Satyanarayan Goyal, he is MD and chairman of the company. He was CEO from 2014 to 2019. Now the company is looking for new CEO. Due to COVID problems, company not able to find new one. And Mr. Satyanarayan, he is MBA graduate in finance and BTech in electrical. If we see the important key highlights, he expanded the portfolio of the company and several digital transformation he brings in the business, that all leads to significant growth. And he has more than 40 years of rich experience in overall power related sectors. And when I see the earnings transcript, he is very open to shareholders, very transparent in answering to shareholders' question. And ownership, he holds only 1,500 shares of the company. Overall, the person sitting at the top looks well experienced and shareholders friendly. Next, future of the business. Opportunity side, management believes exchange penetration will increase in the short-term market due to no long-term PPA signed in last 5 years. And in terms of volume growth, around 41 gigawatt capacity will be phased out in next 5 years. So this will increase volume of the short-term market. And what they are working now is to scale up the company. They are working towards increasing short-term market share. Yes, it is important to retain and improve the profitability, and advanced technology they are building into their products wherever possible. It is important for sustainability and stay competitive. Few new products are lined up to enhance customer experience. And here is the company's presentation snap. Focus on transitioning towards a futuristic tech architecture, from manual workflow to automated one, desktop based to all platform, and limited products to configurable products, and in-house development to partnership. So and it shows they are focusing on healthy organic growth phase. Any acquisition, still now no acquisition, no inorganic growth phase. That's all, guys. And key takeaway for this analysis: business, it is simple and same product using multiple years, and the products bring solution, and the products need regardless of economic condition, products used by DISCOMs and industries. And the bad one, it is highly regulated. And industry, it is sustainability is very high, and industries change, it is near zero rate change, no technology change in this kind of industry. And moat advantage is network effect, but this moat is shrinking now because of the recent trend change. So earnings power is depend on the trend change. Executive side, competitive management, he is shareholders friendly but very low ownership. Future healthy organic growth is available, and no inorganic growth. That is not a bad thing, but okay for this business. And good opportunities ahead, and adapting advanced technology. That's all, guys. And our qualitative analysis is available to check for financial position and valuation. And we have a welcome gift for you. Download IND Money, fund 10,000 rupees in US stock account, and get 1,000 rupees worth of Tesla stocks. If you fund 5,000 rupees, you will get 500 rupees worth of Tesla stock. Yeah, we will see in another analysis. Until then, thank you. Bye bye.